So what does today's jobs report mean for the overall economy and the financial markets? Here to help us put some context around it is Joe Davis. He's the chief economist at Vanguard, the big mutual fund company. Joe, welcome. Good to have you with us. Two important numbers.
Thank you, Tyler.
Terrific to have you here. Two important numbers the past 2 days. Jobs today, obviously, the economic growth numbers yesterday. How strong is the economy in your view right now? And is it strong enough for the Federal Reserve to dial back on its bond purchases?
Well, certainly, I believe it's strong enough to just weather the dialing back of the Federal Reserve. I mean, our theme for our investors throughout the year is that despite the headwinds the U.S. economy faces, is that its resiliency may be underestimated. And I think today's jobs report just underscores that sort of theme, is that despite the headwinds, the private sector in particular is weathering those sort of forces very well. And so I would expect more positive, formative news on the labor market front over the next several months. And so I think that clearly brings into focus a Federal Reserve that is beginning its tapering program.
You know, Joe, the other aspect of it, though, is that the participation rate dropped so dramatically. Does that worry you at all? And might it concern the Fed enough that they hesitate to pull back because people are leaving, they're discouraged?
It does. I mean, I think that's the biggest question among economists and hence for investors as well, is how much of that drop in the labor force participation rate is temporary, meaning it's not permanent, and that some Americans may return to the workforce and actually look for work. And this is actually the single biggest variable with respect to when the Federal Reserve may start to raise interest rates longer term over the next several years. We are of the view that part of that drop we have seen is more temporary or cyclical, which means there is still a decent amount of slack. And so what we are closely watching is wage growth numbers, which in aggregate, even in the report today, is still around 2%. And so it's not suggestive of a very tight labor market, even if we would have consistently strong numbers, much like we saw today.
You know, Joe, you point to the idea of temporary jobs, that being maybe one constituent here, but there are also a lot of people who are working in part-time jobs and at low wages in today's economy. The underbelly of this jobs report is a little soft, isn't it?
Yes. I mean, you can point to the fact of the percentage of jobs that are so-called part-time. It is elevated. It's been elevated since 2008. Tyler, as you know. But that said, if you look back over the past 3 or 4 years and you net out the volatility in those numbers, around 80 to 90% of the jobs created have been full-time. Now, that said, there are some industries that are clearly more high-paying than others. And I think that's a force that we're going to have to contend with in the economy, not just for next year, but for the next several years, given globalization forces. So there are clearly areas of softness in terms of hours worked and wage growth that we can point to, but clearly an important ingredient for the Federal Reserve and for investors going forward is that we have some underlying strength, and I think we saw that today.
You know, you mentioned the Fed maybe pulling back on its bond buying. Yeah. Does that start as soon as December or perhaps early in the new year? And how aggressive might they be in terms of that cutback?
Well, I don't think we'll see tremendous amount of aggressiveness. So, I mean, I think they're going to want to see consistent, compelling evidence of this strength. I mean, just this time last month, there was a considerable concern that the jobs report was too weak. And so I think we're going to want to see consistent evidence. I think, though, a December announcement is possible. I think much more likely could be in the first quarter, particularly January. I think, though, for investors, actually, we continue to be of the mind that it's good news if we are talking about a Federal Reserve that is undertaking a tapering program, because that means the underlying strength of the economy can actually weather and is actually in need of less stimulus. So this is definitely good news.
Joe, we'll leave it at that. Thank you. Joe Davis, Chief Economist at Vanguard.
Thank you.